Idea, Yes Bank, PNB. Every one of these was once the darling of retail investors. Buy and forget, this is going to be a multibagger. That's what you have heard, right? Here's what actually happened to the people who never learned when to sell. In the next few minutes, you are getting three rules that tell you exactly when to exit. Not based on emotion, but on price. You are watching this means that there is something in your demat account, one stock or one mutual fund, that's just stuck, not moving, maybe even red. And even the nifty hasn't given great returns over the last 2 years. Here's the truth nobody tells you: you don't make money when a stock goes up, you make money only when you sell it. You heard it right. Until then, it's not really profit and it's not really a loss. It's just a number on screen. An illusion. Why do we need selling rules? Once you have bought a stock, you actually have only one job left: deciding when to sell, going up or down. That's the market job, not yours. But what do most of us do instead? We refresh our portfolio every hour, and refreshing has never once taken a portfolio up. Selling is the hardest decision you, my friend, will make while holding a position, harder than buying honestly. Because everyone tells you buy and forget, it will compound. So 3 years in, you, my friend, are convinced this one is finally going to be your multi-bagger. Before we move ahead with this interesting topic, a quick disclaimer. I am not a SEBI registered advisor. This video isn't an investment advice, and all investments are subject to market risk. Here they are again: Idea, PNB, and Yes Bank. Ask yourself, why do the big sophisticated investors never hold stocks like these for years, while retail investors are the ones still holding on, waiting for these stocks to become multi-bagger, which never comes? The answer is simple: they have a system for selling. Most of us don't. So, what do we do about it? We build a systematic approach to selling. Because unless you have a clear reason and a clear rule, you, my friend, will never actually pull a trigger and exit the position. And here's the part people miss: even if you buy completely random stocks, a good selling decision alone can make or break your entire portfolio. So, here are the only three reasons you should ever need to sell. Number one, to protect your capital. Number two, to book profit. Number three, to switch out of a non performer into a better opportunity. Get your buying decision right, and you, my friend, have already solved 50% of your selling problem. Let's go through each one. Look at this. These aren't small cap gambles. Reliance, TCS, HDFC Bank, Infosys, blue chip safe names, and over the last 1 to 2 years, most of them are sitting in the red. They were once the darling of every portfolio. Good companies can still give you negative or zero returns for years. So ask yourself honestly, is the stock you are holding right now sitting on this same list a year from now? If you buy something that's falling, assuming this is the bottom, understand the bottom might not be in yet, and that can seriously hurt your portfolio. Bad market cycles, war, climate shocks, a shift in what customers want, even fraud, and any of these can quietly turn a good company into a value trap. So, what should trigger you to review your decision? Look at the stock's price movement over the last 1 to 2 years and mark a key level below which you, my friend, exit. You can also draw trend lines as a dynamic version of that same level. Once that level is broken, you take the hard decision. You exit with a small loss. Yes, if the stock turns around later, you can always buy it back. But if it keeps falling, it keeps eating into your capital. This is easier said than done, accepting you were wrong early without ego is one of the hardest things in investing. Here's what that actually looks like on a chart. The trend line breaks, that's your cue to review, not to hope. This one's easier to act on, but only if you already have rules going in. There are two ways to do it. Number one, you decide a target percentage in advance and exit there. Number two, you ride the trend and trail your stop loss, accepting you will give back 5 to 7% from the peak. This second method takes longer to master. You can trail your stop using tools like 13 period moving average, Supertrend, or Parabolic SAR. Take a look at Maruti. This is SMA 13 in action. As the stock moves into profit, the stop level rises with it. When price closes below it, you exit. Same setup using Supertrend this time, and here's Parabolic SAR. All three have different sensitivity to price movement, but they all do one job: stop you from getting stuck in a downtrend. Nobody buys the exact bottom and sells the exact top. If you have captured even half the trend, you are already ahead of most of the people. Most experienced investors actually use a hybrid: book partial profit at a pre-decided level and let the rest ride with a trailing stop loss. Two triggers here. Number one, a genuinely better investment shows up. Number two, your current holding has gone into a consolidation, going nowhere. Use a time stop if a stock hasn't started trending in the next 3 months. Treat it as underperforming. One honest caution: sometimes the stock you exit ends up performing better than the new one you switched into. But that's the part of the game. You get better at reading this with time. Look at this side by side. Same time period. Two of these stocks went nowhere. Two of them ran. Your portfolio should be built from stocks that are on the move, not ones sitting in consolidation while other sectors quietly compound. Quick favor before we go further: if you have watched it till here and this framework is already making you rethink one stock sitting in your portfolio right now, hit like and subscribe to my channel for more updates. Because the next video in this series goes deep into stop loss placement, profit booking, and trend identification, one topic at a time. So, how do you actually put this into practice without babysitting your portfolio all day? Two ways: set price alerts on your broker app that ping your phone, or better, use GTT orders. A good till triggered order can sell a stock on its own the moment your condition is met. You can even place an OCO order valid for a full year with both your stop loss and target set at the same time. Here's exactly what that looks like on ICICI Direct and on Zerodha Kite. Most major brokers offer this now. One last thing before you go build this: don't apply any of it to your full portfolio on day one. Test it first with a small position, review it after 20 closed trades, not 2, not 5, 20, then fine tune it with your own personality as an investor. And here's the only scoreboard that matters: if your profits outweigh your losses over those 20 trades, you, my friend, are making progress. That's it. Quick recap before you go: 3 reasons to sell: protect capital, book profit, or switch to a better opportunity. Each one has its own trigger. Screenshot this if you need it. and I will see you in the next one.